Guys, with gold around $3,400 an ounce, everybody is talking about the gold-silver ratio being around 100, but no one is talking about a much more important ratio, the gold to oil ratio. So I'm going to look at that and see if it may be a good time to swap out some of your gold for some oil stocks. So let's take a look at that. So here's a historical chart of the per ounce price of gold divided by 1 barrel of oil. So basically these numbers say for every ounce of gold, how many barrels of oil can you get? Now you see the historical average is somewhere around 16 barrels of oil per ounce of gold. So here the low in August 2005 was only about 6 barrels, and the high up here during the pandemic when the price of oil went to about $23 a barrel and gold went to like 2,000, the ratio was about 91 barrels. But here we are, we're about 58 barrels per ounce of gold. So that's a big difference from 6 barrels down here to 58 barrels up here. So this ratio could mean either gold is a little too expensive compared to oil, or oil is cheap compared to gold, but it's more likely that gold is too expensive compared to oil and the gold-silver ratio and things like that. So it is gold that is out of whack here. And if you actually look at the inflation-adjusted monthly average crude prices going back to 1946, you see that the inflation-adjusted price since 1946 is this blue line, about $57 per barrel. And if you go back since 1980, the inflation adjusted price is about 70. And since 2000, the inflation adjusted price is 78. So oil is cheap on all of these metrics, or just about even priced based on going back to 1946 inflation adjusted price. So not super cheap, but still relatively cheap compared to the inflation adjusted price in June 2008 of $183, where the nominal price was about $126. So this is the nominal oil price, and in April 2020, it was about $20. This is not adjusted for inflation, and here you see it was about $140 in 2008. If you adjust it for inflation, you see this low price was about $23 and the high price is about $204, and we're sitting here at like 58. So it is about a third or so of the all-time high. Now, for you people who see gold up 40% or so in a year and think it's just going to do that for the next 10 years straight, look at this table of investment returns by asset class 2010 to 2024. And you see, yes, gold has years where they are almost the highest return, right? This is the best, this is the worst. But then a year later, it's down here, or down 29%, or down 12.3% when something else takes over as being the best investment. So there is no period where gold is up 30, 40% every year for 5 years straight. And so if you look at this table from 1974 to 2023, you see gold has some good years and some bad years. But everybody remembers this year when it was up 133%. And I'm sure everybody who was buying here thought it was just going to continue like that forever. But 2 years later, down 32, right? So it has its ups and its downs. And there are, even in some good years, there are no years where it is up 20, 30, 40% a year for 5 years straight or something like that. Although this was close, but after that, you have the hangover down 27%, down 11%. So gold is definitely extended. Could it go up a lot more? Sure, of course it could. But don't think it's going to go up 20, 30, 40% every year for the next 5, 10 years or something like that. The people that think that are probably the same people that were paying 70% premiums for silver eagles just a few years ago, thinking that silver is going to the moon or something like that. And those same people are now dumping silver for gold. So there's a saying that high prices are the cure for high prices, and low prices are the cure for low prices. And what that means is when gold or any commodity gets too expensive, some of those mines that were not profitable at the lower prices now become profitable. So if a gold mine is profitable at $2,500 an ounce of gold, they won't dig when the price is lower than that. But when it gets a lot higher than that, a lot of those mines will come online and start producing as well and bring more supply to the market and therefore eventually bring the price down. So if you look at the cost to produce gold and silver right now, you can get an idea of how expensive or overpriced gold and silver are relative to what it costs right now to dig them out of the ground. And this term is called the all-in sustained costs. So that is the mines, how much it costs to dig out this stuff, plus the overhead and the labor and the insurance and all of that stuff. So let's take a look at that and then also look at oil production costs and see which one looks like it's cheap and which one looks like it's expensive. So I did this search on Grok AI and it goes all the way back to 1915, but I'm going to start say 1970 after Nixon closed the gold window. So here is the all-in sustained cost for gold, about $50, and the gold price was $35, but then it went free floating, and you see in 1980 the cost is $200 and the price was $612. This is the average yearly price, but it went to like $800. So a factor of 4 difference between what it cost to what it was selling for. And that didn't last too long. And then by 1990, it was costing $300 and the average price was $380, right? In the run up in 2011, the cost was $900 and it ran up to about $1,900. So about 100% more than the actual cost. And now in the last few years, 2018 going up to 2024, it's around $1,250. I believe it is more than this, maybe as high as like $1,600 or something like that. So here in 2024, the average price is about $1,250. I believe it's more than that. I think it's more like $1,600 recently. And the current price is about $3,400. That's about, again, 100% more than the actual cost to produce. And so you see in history, when it gets much more than that, it tends to snap back, except for back in 1980 when it went crazy. So is gold really going to go to $10,000 an ounce while it only costs $1,600 or $2,000 to produce? Not for a long time. And looking at the silver costs, you see it's $22 cost and the average was $28 over here. Right. In 2011, when it went to $50, the cost was only $16. So it went up 3 times the cost and then came crashing back down, more in line with the actual cost. Now, what about the actual cost for oil per barrel? Some countries like Saudi Arabia and PetroChina and Russia, their costs are pretty low, like $10, $20, $25 or so. Even Petrobras in Brazil is like $35. U.S. companies like Exxon and ConocoPhillips, their costs are more like $40 for older wells, but their costs may jump up to close to $60 for newer wells that are coming online. So here's some assumptions. Permian Basin wells may have break-even prices as low as $31 for existing wells, but $62 for new wells. So the price of oil is not super cheap, but it is at the lower end of the historical range, inflation adjusted. And so if you were thinking of swapping out some gold for oil, you can buy the XLE ETF with a 0.08% expense ratio. And it has about a 3.5% 30-day SEC yield. And 40% of the XLE is basically Exxon and Chevron. Another 7.5% is ConocoPhillips. And so there's 23 holdings in the XLE, with the average price to earnings ratio for the whole XLE is about 15. Not super cheap, right? Or you can pick and choose a few of the stocks in the XLE, especially the big ones like ExxonMobil and Chevron. All right, Exxon almost 3.8% dividend, forward PE of 16.4. Debt to free cash flow just 1.33, and the free cash flow yield is 6.25. So if you take all the yearly cash flow and divide it by the market cap, you would get 6.25%. Right, looking at Chevron, better dividend, 5%, a little bit more expensive, 17.5 PE forward. Debt to free cash flow, 2.17. Free cash flow yield, 5.71. ConocoPhillips is cheaper than both of them with a forward PE of 12, a dividend yield of 3.56, right? Debt to free cash flow 3.17 and free cash flow yield 7.22, and maybe even throw in a refiner like Valero, forward PE 16.5, dividend 3.87, debt to free cash flow 2.25, free cash flow yield 13.19. So oil and oil stocks are not super cheap, but if the run up in the price of gold has now brought the percentage of your net worth in gold a lot higher than you would normally like, you may want to rebalance some of that gold, that higher priced, into this relatively cheaper oil and oil stocks at least. And so you can buy the XLE ETF, or you can buy a few of the big ones like Exxon and Chevron, and even sell some covered calls on the ETF to get a little bit income as well as the dividends. Now, you would still have to pay up to a 28% tax rate as a collectible on your gold gains, which is ridiculous because you don't have to pay tax on the gain on your dollars when it goes up against another currency, of course. So if you have to lose 28% of your gain just to switch to some oil, it may not be as attractive as the ratio suggests. So even if you are not thinking that it's a good idea to switch up to oil stocks, it may be good to lighten up on some of that gold if you have some things you may need to buy soon. So guys, don't assume, just like every Johnny come lately to gold, that just because they read a Yahoo article that gold is up 40 or so percent in a year, that it will do that for every year from now on. I was holding gold as I watched it run up to about 1900 in 2011 and then fall about 40% and not recover that high for about 9 years. So this window may not stay open forever. And I know it's different this time because of the US debt and all of that. Well, gold is also going up against all other currencies as well. So it's not just the dollar. And it is mostly third world central banks that are buying gold, as well as a lot of Chinese investors and things, because their stock market and their real estate market is doing really bad. And so that's the only place that they feel safe to put money into. At some point that could change and those central banks could stop buying, or the retail buyers could start to become sellers because the price got up to some level that they consider too high. So what do you think? Is oil looking cheap to you based on the price of gold? Would you consider swapping out some gold for some dividend-paying oil stocks, or, God forbid, even some silver at a 100 gold to silver ratio? Let me know in the comments. Thanks for watching, guys.